Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome to Black and White Market Chatter on Life Planning 101, where we believe investing is black and white. We believe our number one goal is to keep clients invested by providing education, discipline, and support. We believe by removing the emotional gray area of investing, you may get the return you deserve. My name is Matt Ervin of Kennedy Financial Services, and we are joined today by our lead strategist and portfolio manager, Aaron Kennedy, as well as our analyst, Sam Barker, with special guest, Brent Bible, who comes to us as an advisor of the firm with 10 years of banking experience prior. Thanks, gentlemen, for joining us today. Aaron, we're going to talk a little bit today about some economic data that's come out recently. And then we want to touch on some portfolio updates and changes, mentioning a few of the companies that we're reviewing, some do's and don'ts, some ins and outs. We're looking forward to hear Brent's opinion on some of those things as well.
It's all about Brent today.
So let's get started with the economic data. What were you telling me about the housing markets?
Housing's it's not falling apart. Man, we're not building housing, anything. When it comes to commercial real estate, nobody's willing to stick their toe in the water and start building at this point. I think new housing permit starts were down another 5 to 6% on the last reading, and it hasn't. We've gone all the way back to 2020.
Wow.
That's a long time. And it doesn't seem that, but our population is growing. How many new people are here in the United States versus 2020, and we can't build homes?
Yeah, it's pretty amazing because
economics don't work. Yeah.
There's a lot of places around that seems like housing developments are popping up everywhere you turn. So to kind of get a pulse on the national averages versus general regional data is pretty interesting.
Yes, it is, and that it affects so much. If you think about it, the largest asset the majority of people own is their own home. So most people spend an entire lifetime to get that wealth. What is a mortgage? 30 years?
Yeah.
It's literally a lifetime to get that asset, and we're not creating any more. And we've been in this kind of downward spiral when it comes to housing for a huge number of years. We are defaulting down to where the majority of Americans don't have homes to move into.
Right.
We've been slowing our build for a long time, and they just give you some numbers from the last time that this was reported. We're down 5.5%, and from a year ago, we are starting 20% less houses today than we were a year ago, and then this has been going on for quite a while. So we can really see what's going on today. Interest rates are 6.8, 7%. There was this magical time when was it, 2022, that everybody's home fairy came to them in the middle of the night and doubled the value of their home.
That's right.
I don't have kids to have the tooth fairy, but I was there for the house fairy.
There you go.
So things are extremely expensive, not only on the actual dollar per brick, but how much the bank is going to charge you per brick has gotten astronomical as well. Just kind of an example, I was looking at a house the other day, and dollar for dollar, if I were to buy today versus what I bought in COVID, it's going to cost me an extra 50%. Just going to the bank. And that's not fair. Of course, my insurance went up double too, but that's still a small
and taxes,
spot. Yes.
Right?
Yeah, and you get that little breakdown of insurance, taxes. That part of it was actually more than the principal I'd be paying.
Yep.
Taxes and insurance. What a beautiful world we live in. Absolutely crazy.
It makes it pretty hard for couples, young couples, or young people to get started.
Yeah, how do people get started? This is scary.
Yeah.
But on the flip side, One of the areas that developers and the real estate market's actually scared of is multifamily, because they're saying we're overbuilt. There's too many of them, and I don't think that's right. I think the people are charting things out and saying, hey, this is abnormal. But, if you think about it, if you can't afford $430,000 new home, where are you going to go? You're going to go to a nice apartment, nice condo, something. And there's a lot of nice ones out there. Plus, you got all the colleges. Colleges are growing like crazy. Attendance is growing, population. So a lot of those big college towns have huge booms in multifamily. But, everything is a double-edged sword. Everything out there.
Yeah, and we talked about on previous episodes that trend of kind of pre-COVID, people were migrating together into those types of multifamily where they would have shared amenities. They might have restaurants or breweries or things like that made it very attractive. And then during COVID, it was, we've got to get away from each other. We've got to go build our house on 1 acre, 2 acre, get our chickens, get our stuff. And that was kind of that trend. And so
Not in Eastland.
No, not in Eastland.
Stay away.
Right, not in Eastland. But what you're seeing now is that people still want that. Everybody wants the house on acreage that they can have their small farm or whatnot, but they can't afford it.
Yes.
Can't get started. And unless, you're splicing up grandpa's land and chunking an acre off or two for all the grandkids to move back in, it makes it really hard for people to afford A, land, but then B, to be able to build a house on it.
Yeah, this is the part where we're jumping way off our agenda here. But
That's
yeah,
what
this
we
is
do, man.
huge.
That's what we do.
I mean, I've talked to so many people that says, hey, I'm going to go buy that 200 acre lot, or I'm going to go buy that 400 acre piece of property, and I'm going to turn it into 1 to 2 acre lots. And you took something that was affordable, it was just a blink of an eye ago that acres here anywhere were $5,000 an acre. And now when they chop them up, they're selling for $15,000 and $20,000 an acre. How do people do that? And on a side note, who's gonna feed us?
Right.
How can you start a cattle ranch or grow wheat? Things are getting so expensive. Being a landowner is going to be something of a dinosaur.
Yep.
And it is approaching so fast. I mean, it already passed us.
Yeah, it's pretty tough. So before we switch gears into the portfolio and some of those companies, is there anything else you guys want to add to housing?
Is it, do you think that it's a missed opportunity for those people who have or will soon be selling off chunks of their land? Or do you think that it's more of an opportunity that if you currently hold property, you should continue to hold it and see, is it good to be a dinosaur?
Yeah. I think absolutely it's better to be a dinosaur. But you got to figure out what you're trying to do. If I'm trying to make money in 2024 or 2025, then get rid of it. Chop it up and sell it. If you want to create generational wealth for your great-grandchildren and your great-great-great-great-great-great-grandchildren, you hold on to it. So what is your goals? Because who here has watched Yellowstone and those movies? I mean that's pretty true. They're pushing people away from the ability to own land. So if you do, it's going to be life-changing for your family in the future.
Well, and go back to when we started having elections in this country, right? When we first got started, you had to be a white male landowner to vote.
Yes.
That was the privilege, and of course it's expanded wildly beyond that because we know it should be, but still they're not making any more land.
And you know what? Boy, we're probably going to get some bad emails, and I'm not talking white male landowner.
That's Brent at Kennedy-financial.com.
But, man, I kind of think if you're going to be voting, you should have some kind of skin in the game. If you're working, if you're paying taxes, if you're doing these things, that should kind of be your voice. And I know that's not going to be a popular opinion, and I'm not saying white male landowner, but hey.
But your point is taxes. Like, if your tax dollars are going into the pot, you should have a say at where they go.
Yeah.
If you're not paying any taxes in,
You're voting to take more money from me, or Sam, or Brent, or you. You know, that's
Maybe
vote.
more of a meritocracy approach.
If you're a productive member of society.
There it is. There it is. Productive member of society.
that's Brent at Kennedy-Financial.com. No, that's great. That's great. All right, gentlemen, let's switch gears a little bit. So, looking at the portfolio, of course, we want to remind you this is never a recommendation to buy or sell. This is just some general feedback and thoughts on some companies that we're looking at based on the underlying fundamentals. So, what are some of the things that we're seeing, Aaron?
Well, start off, I thought this would be fun. You know, when we're looking at these things, poor Matt, poor Sam, they're going to get 100 dang texts. What about this? What about this? Imagine if this happens. And I thought maybe we should go through this in this episode. So, one of the ones we're looking at is Company FICO, Fair Isaacs Corporation. If you've ever had to go get a loan or anything like that, you probably heard of your FICO score. And what's interesting about them is they are a necessity. You have to have them. And it's mostly technology. They just absolutely just print money. If you just look at their change in working capital and their capital expenditures or the money it takes to keep their fixed assets going, the difference between what they're spending and what they're actually putting in the bank is almost 100%.
It's pretty good.
They spend $1, get $2 back. So this company is amazing. If I had to say what they do, it would just be they print money. The bad thing is they're very, very expensive. Let's pull this up. Most of the time when we look at this type of company, you know, we would just skim right over them, because right now their PE is 74.5. So if the company stays where it is and never grows again, the company, not the stock, 74.5, that means it's going to take 74.5 years to get enough earnings to pay me back.
Right.
That's a long time. I'm not that patient. We talk about the advancement in healthcare and how long our life expectancies is going to be, but I'm still not that patient.
Man, that's an interesting side note there.
Yes.
You know, investing in relation to your longevity by PE.
there you
Goodness,
go.
there's a whole deep thought there.
There you go. But you know, it doesn't take a lot of money for this company to run. And, you know, we talk about this a lot, the return on invested capital, the amount of money that they make on what they're spending in their assets is about 40%. That is out of this world. And if you want a loan, especially a mortgage loan, you have to go through FICO. So there's an absolute need. They're partnered with all the 3 ratings agencies, and not only do they all work together, but there's certain rating agencies that use them on their side as well as a partner. So they're fantastic. Like I said, they're free cash. Yeah. Looks like they're spending somewhere around 125, 150 million, and their cash flow is 467.
So
That's not bad.
Well, tell me, what's a disruptor to them? So it sounds like they have a pretty proprietary market.
Here
right?
we go. Yes.
So they've got to have, I mean, the way technology is moving, surely they'll have a disruptor if they don't already.
Yes. There's a company out there called Vantage that is a direct competitor. They really haven't made enough headways to move into it. But on the flip side, what happens if housing slows down? that's a huge part of it. And we were just talking about how much housing builds are decreasing. So now we're going to look back and say, what is the longevity of banking? What is the longevity of the American dream of owning a home? And is this going to increase, stay the same, or change?
Mm-hmm.
You know, so this is where it gets creepy. Because I would take them, even at how expensive this is. This would probably be a company I would invest in personally, and let it run for the next, what's my life expectancy?
Yeah.
3.5 years.
That's a whole nother podcast.
Yeah. Let's pretend I got another 40 years. This would be one of those companies that I would love to hold in my portfolio for the next 40 years. But you know what's going to happen in 2027 or 2028? You know, the short-term disruptions of where we're at today with interest rates and inflation, hyperinflation. This could cause a huge slowdown on their private mortgage side.
Yeah. Well, my mind goes to, you think about '08, and one of the things that caused that is handing out loans to basically anybody that had a signature, right? So is there a situation that could come up where, this, I think you said Vantage Point, would give them maybe a better interest rate than the FICO score would? Is there a situation where that could come up where you start using the other because it's more favorable to the lending environment, or are they calculated the same way?
They're not calculated the same way. And, FICO's been doing this well over 100 years. They are way ahead of everybody out there. So I don't think we get to a point that one's going to be better than the other. I'm comfortable with using this company, and it's hard to break into that.
Sure.
But one thing, this is kind of answering it, not really, but during '08, there was a lot of companies that failed.
Mm-hmm.
And there was there were companies that were blamed for not finding first. And now we're going to move over to Moody's and S&P Global. These companies were actually blamed, and they were hurt because of the economic situation we were in, and they had rated these bonds differently. So, maybe there's a point in the future that someone says, "Hey, your algorithm doesn't work anymore."
Yeah.
And then they can get blamed that way. But
when we talked a little bit about and I think China does this, that social credit, where if you jaywalk, they're going to ding you. I read something the other day where you jaywalk, they ding you a ticket, and then they track your walking patterns, and it goes against your social credit. And if your social credit gets too low, you then can't buy certain goods or services.
Yes.
I think it was play video games, to be honest. I think I read that. But not saying
it's a real thing.
It is very real. We laugh because it's not here, right? It's not
It just
here
seems
today.
obscure and just outrageous.
Yeah, that's a great way to say it. But think about 20, 30 years down the road where our lives are already ingrained so deep in technology, and vehicles are going to be... So maybe you've gotten 17 speeding tickets. You no longer can operate a vehicle that goes over 65 miles an hour. That's something that could be real. It seems weird, but...
Hey, Sam, can you pass the tinfoil hat over to me real quick?
Yes, I'd be happy to.
Yeah. Now, you're exactly right. Because, you look at your phone. Who are you sitting next to? Who are you talking to? Were we talking about this the other day?
Yeah.
Where are you spending money? How fast do you drive? They can control. They know everything you're doing. We were going to have the central bank digital currency. They know where you're spending their money. They know who you're hanging around. And yes, it's already being used in other countries. It's going to come here. It's just going to be a question of when. Okay, here's your tinfoil hat back.
Pretty interesting stuff.
It's extremely interesting. One thing that I was reading recently, and this is more cultural than what we typically talk about, but it seems like society, especially in the Western world, is getting more into a shame-based society instead of a guilt-based society where, maybe it's shame that motivates people to do or not do things instead of their own personal guilt and feeling of responsibility. And I think that social credit system is kind of the apex of what we're headed towards, where the government shames you for jaywalking instead of, or passing, trash on the sidewalk or whatever it is, instead of feeling that personal guilt and responsibility to pick it up. Ultimately, somebody's going to have to hold our shameless society accountable, is I think what we're headed towards.
Yeah.
That's pretty interesting. So.
And this isn't just something today. I think my sister Angela was talking about, she was working with a life insurance company, if I remember this right, and if she wore this watch that will let them know when she exercises all of her daily activities.
Yeah.
It would show them that she's being healthy and be very health conscious, and her premiums would be lower.
That's right.
It's very innocent, right? Hey, I can save money. That sounds like a great idea. Same thing with the DNA testing, right?
Yeah.
Let's do the 23andMe, and let me show you where your family. Was that as innocent as it ended up being?
Right.
This was just data collection to know where the
They do it
population
in the auto insurance world, where you
Yes.
plug that little chip into your car, and they say, well, it'll diagnose it when you have an issue. Well, I can go to any AutoZone or O'Reilly's or whatever, and they can tell me when I have an issue what the light is. I don't need that, but it would also track my mileage, my speed, my direction, how quickly I stop.
How did we get here?
Social credit.
Social credit.
All right. Well, let's
back to the FICO.
Yeah, let's switch gears, right? So interest rates is something that's obviously top of mind, and I think it's one of the things we've been trying to capture is interest rate return using CDs.
Yes.
Something else you want to touch first?
No. Yeah. On the social credit, we were talking about what happens if banking actually slows down. What happens if we have a new way of moving our money in our system, and how do consumers get loans? And that's where we were starting to talk about the social credits.
Oh, yeah,
So,
absolutely.
Even if if we have a new banking system, then FICO could still be used, maybe not through the social credits, but through peer-to-peer loans. Surely they will have something to give people an idea of how creditworthy the lender is.
Yep.
So we don't sound crazy.
Leave it to our specialists to bring it all back to common sense and logic. That's great. So, and like I say, with banking and interest rates, so let's talk a little bit about that. So investing in interest-sensitive vehicles sound really great. Right now we're getting some pretty advantageous interest rate return, even things as simple as the money market. And I think that was one of the concerns is those are what we call floating rates, and they float with they're a multiple of the Fed funds rate, meaning they work off of that. The Fed sets the overnight lending rate, right? And then every other interest rate is based off that price. So what are your thoughts about adding, keeping, or removing money market or similar type funds to what we're looking at?
Well, and let me interject really quick. So I was looking at some charts earlier, and as inexperienced as I am with interest rates being where they are, I started playing around with it. And if you had invested $10,000, or let me rephrase, if you had an investment of $10,000 that had increased as fast as the 3-month Treasury bill rate had increased, you would have over $1 million right now.
What time frame?
I don't remember the exact time frame.
Sam, come on now.
It would have been since they started raising interest rates from near zero to today. It would have been north of $1 million. And everybody talks about how fast the interest rates changed and how fast and how high they changed. And you can look at charts and it's pretty much a straight wall up, and it's kind of been flat and a little bumpy since then. And looking at a chart, it doesn't mean a whole lot, but then when you see how many times over it's doubled just to get to where it's at, it's pretty staggering.
It is. It's phenomenal and scary. And you're right. We've had a lot of fastest in history. You think about COVID, that was the fastest drawdown in history and the fastest recovery in history. When you look at when interest rates or the inflation bug just hit, that was the fastest increase in interest rates in history. You know, these are things that we've never seen before. We've never tested the system to see if we can hold up by putting this much stress. So it's this is going to go in the history books. This is fascinating stuff, absolutely fascinating. And you know what you were talking about earlier, we're actually looking at a company that benefits from this, and it may be the most boring company on the planet. It's a company called Federated Hermes, and they're well known around our country for creating money markets. So they invest. It's basically, if you own a money market, it's basically like a savings account. They're buying super short-term securities to get you a good rate on your money. Is there anything more boring than that? Hey, everybody's getting 5% on their cash. That's exciting, but not very exciting. Now they've been buying up other companies, and they do have some more assets other than just their cash-like securities. They have regular stocks and bonds, but this is what they're well known for and famous. And more than likely, it doesn't matter where you've been other than Schwab. You've probably owned a Federated money market account.
And to your point, it's exciting now at 5% rates.
Yes.
It's not exciting when rates were zero, overnight rates were zero, and you're getting 1.5%. Yeah. That's boring.
I know when we were deep into that. Hey, we can leave it in cash and get 0.01, or we can move it to the money market and get 0.08.
Yeah.
There's just there's not much. And then if you're either going to get a penny or a penny and a half, most people didn't benefit. The hay penny doesn't exist anymore.
Yeah, that's right. That's right.
But this company, they are, number one, they're just dirt cheap. We were talking about FICO taking 70 plus years to pay you back. Federated pay you back in 9.
Hey,
9 years. So their return on invested capital is almost 20%. Very, very little money to produce what they're doing. Their free cash flow is $312 million, revenues of $1.6 million, and operating margins of 25%. So this company is also just knocking it out of the park. But can it continue on this way forever? Where interest rates going to be? I mean, 2 years from now, if interest rates are back to zero, I don't know. That makes it a lot. There's a lot of fog there. But what if it stops at 2? What if it stops at 2.5%? Or what if it goes up to 7? I mean, this kind of company will continue to just operate and perform. And if you think something, I'm gonna go back to Schwab. Schwab's not going to pay you anything on their cash. Their cash is still going to be 0.01. So if I had the option between 0.01 and 2.5, I'm going to use the money market. What if it's 0.01 versus 1? I'm still going to use the money market left and right. So this company has a lot going for it. They're super efficient. They are growing. They are looking to expand. They've already noticed that being in cash is maybe not the best thing. That they bought a company, Kaufman, that we've been following for 25 years. So they're actively growing. They're dumping a ton of cash in their bank account. So they're doing everything that they should. But there is risks.
Well, so let me ask this. So when did this company start? Is it like a long time ago?
Yeah.
Okay, so my point there
Let me
is
see if I can actually get a date.
right. So my point there is we've seen. So when was the highest interest rates?
Back in the 80s.
Okay, so my point there, if they started back in the 80s, we've seen them at the highest interest rates, and then we've seen them at zero, and they seem to still be in business, right? When you break it down that simply, you've seen them at their high and their low, and obviously the way they transact business would get more efficient over time.
Let's look at it this way. So I'm pulling back up
You
our
don't like my
return
way?
metric of return on invested capital. Yeah, you're getting too much in the weeds there.
Oh, trying to keep it simple.
Yeah. So even when interest rates were zero, these guys were still making 25% return on invested capital.
There you go.
So every dollar that they'd spent, they're making 25%. Their low point, it looks, I'm just scanning here. 2011, they only made 16, and then they were making 17 somewhere in 2014. So that tells me that the assets they have, the asset utilization, how efficient they were. They've always been a company to know where their revenue streams are and be able to make money off of that. And good times and bad times, and here, the return on invested capital has actually gone down from 2020 until today. It was 26 to 20. So even today, it looks like they're purchasing and they're going out and spending money, in which we want them to do, to get those high returns.
I think that's exactly what I said, isn't it?
Exactly. I just needed to make it a lot more complicated
you go.
and all that good stuff.
No, that's good. That's good. So,
But here's the cool thing. Okay, go ahead. Sorry.
well, no, I was just going to say I think there was another company. So if you have something else to touch on, let's wrap that one up. I think there's one more exciting thing to talk about.
So, if I had my way, I'd buy a company and hold on to it till the end of my life expectancy. Forever. I only want to buy companies that I never have to sell, and I know that should be everybody's goal. And this company looks like it could. How efficient it is, how much money it makes. It's other than the actual how expensive it is. This fits that, but this actually fits another niche inside of our portfolio, and it actually helps hedge what we're doing, because this company is going to make more if interest rates go up. If you can get a savings account for 7%. People are just going to start selling everything and just dumping money in their money markets to get that cheap return. So let's compare that. This company benefits of interest rates or / inflation or anything else they benefit. If interest rates come down, this company has a chance to be hurt in the short term. But what other companies in our portfolio are going to benefit from that? So that's the really cool thing about this. This is a company that's going to make money on its own regardless. And if interest rates come down, which is going to be a perceived weakness, what about our hyper-growth companies in there? Let's say NVIDIA or Amazon, Apple, any of these companies that have been growing like crazy, that's going to be the wind in their sails. So normal years, everybody makes money. Interest rates go up. Maybe your Federated makes more money. Interest rates go down. Maybe your hyper growth companies go up. I mean, this is a really cool company, and it diversifies us in different interest rates environment. Now, I think that is the most exciting thing.
You spoke about FICO earlier. So interest rates go up. Theoretically, housing starts go down. Less people can afford housing. FICO, their revenues probably get hurt due to a lack of housing starts, less people trying to buy homes. So it also hedges FICO. Correct?
Yes.
Yeah.
Yeah. And what's crazy is we've been digging through all this stuff, and I basically do this on a daily basis and look and see what's out there, see where we can go. And the most exciting thing is in the financial industry, and it's not banks. You think FICO, which is lending scores, Federated Hermes, money market.
Mm-hmm.
These are boring financial companies that are still in the industry, still in the sector, but it's just looking at things a little bit different other than traditional banking.
Well, and I think the evolvement, like they can evolve with the times. I think that's the thing I like the most about them is they were good 10 years ago, they're good today, and not because they're the best out there or they're the most attractive thing, the hottest thing on the market, but they evolve with time. And that's really something when you talk about what is something I want to hold for the next 40 years, you want something with a track record of evolvement.
Yeah. And FICO's there. You got FICO 8, you got FICO 9, you got FICO 10, and they keep expanding to bring in all these new variables. You know, now a lot of banks aren't using those newer ones. They're still stuck on FICO 8 because that's what they're comfortable with. But to your point, they have expanded to get people the right information, and those newer scores is to compete against their current competitors.
Yeah, pretty exciting stuff.
Exciting, and especially when we think about, hey, FICO makes a penny off off of their score.
Right.
You know, I can't remember how many. I have this somewhere. How many billions or trillions of data points that they have that they made a penny a piece on. You know, that's good money.
That's
Yeah.
good money.
Yeah.
Well, good. So let's talk about the last. I think you had one more company on your list talking about a little bit. It's different, right? Because we've been talking about kind of digital assets, banking, transactional. Let's get back to the hard assets, the real assets.
Yeah, this is probably one of the coolest ones. Again, this is not a recommendation to buy. The company's called Texas Pacific. It's basically a company that owns a bunch of land. Now, it just got added to an index last week and a half ago, so something like that, and it's up astronomical. But that's not because of the company. It was because it was added into indices. So please don't take this as a recommendation to buy. But this company owns hundreds of thousands of acres of land, and they also own the mineral rights to that land. So they're leasing out those rights, and that's where the majority of their income comes from. So they're selling their minerals or their oil and gas. They also have water rights. They're selling that, and they're also coming up producing things on ways to clean the water from the fracking process. And after they've already owned the land, you know, what cost do they really have? Maybe a phone bill. You know, there's not a lot of cost out there whatsoever. And let me pull this up. The amount of cash that they're producing versus what they're spending is just crazy. Now, this would have been another one I wish I would have bought as a toddler, you know, because the bad thing is if you're selling mineral rights or you're selling your oil and gas, those wells only have a certain amount of years, right? And if we're pretending that natural well is going to last 20 years, you know, that should give you your time frame. Now, we know things happen just like the horizontal drilling and everything else where technology can change the amount of production we can get on land. And I'm not saying that that's not going to happen again, but you know, as of today, we have a finite life of those that production.
Are they limited to the mineral rights? I know that's what we're camped on at the moment, but when you think about things like, you know, cell phone towers or other type of, you know, above the ground infrastructure, would they still have that ability to expand?
Yeah, they own the land. I mean,
Okay.
they will do whatever it takes to make money, and you know, just from an efficiency standpoint here, they brought in $660 million. At the end of the day, they put $410 million back in the bank.
Wow.
You know, so that is almost 80% margins putting that back in, which is just just amazing. Their ROIC, or return on invested capital, is 45%. So
And just for reference, what's the industry average or a common return on invested capital?
it's going to be closer to the risk-free rate. We're actually looking for anything greater than 15%.
There you go.
So this company is knocking it out of the park. So yes, this company is operating fantastic. So if we're dealing with something like this, we got to say, what is this company going to do with their cash flow? If they turn around and send it back to me and say, hey, here's your big dividend, you deserve this, pat me on the back and all that, our oil runs out.
Right.
And this company disappears. That's not worth it. This is not something I would ever touch if they were just sending me back a huge dividend. But if they're taking that $410 million and looking around Texas or any of the surrounding areas, and they're going to buy more properties, or build more technology, or put in new towers, or whatever, then yes, lead is all day long.
Yep.
So if they're taking that 410 and they're able to make 45% on their ROIC, let's go.
Yep. And you talked about refining the water. Is that them doing it, investing in that process, or is that having the water once the technology has come along to kind of repurpose that frack water?
Yes.
To all of it?
Yes, to all of it.
Oh, okay, there you go.
Yes.
So really quick, this is in an industry, and specifically oil and gas is pretty volatile. Being right on I-20, we see every 3 to 4 years there's just a truckload of people that head to West Texas. And then every 3 to 4 years later, they start heading back to wherever they're from because there's been an oil bust or an oil boom,
Yes.
or vice versa. So what does this mean? You said that you'd like to own this from the time that you were a toddler. How easy is it to hold through the swings of the commodity prices of oil and gas? Can you kind of dig in a little bit on, and we were talking a little bit about how, Warren Buffett has been building a position in Oxy, and he's really big on don't be a speculator, be an investor, buy for the long term. Well, you don't know, you can only speculate what the prices of commodities are going to do. And so it seems to me that he has an underlying reason on building a position in Oxy outside of the commodity prices. And I'm curious as to what your opinion is on how the commodity prices are going to affect this company.
It affects it. It is, if we would put this in, this would be one of the more volatile stocks. Looks like the volatility of monthly returns is somewhere around 50%. So if I make 1% one month, I can make 0.5 the next, or 1.5, and just back that bounces around. And you can go back and look at it in the charts. And this needs to be one of those companies that you do not pay attention to, because number one, commodities are volatile, very, very volatile. But something like this, if I own royalties, when do those royalties get really expensive? When oil and gas is good. What happens when oil and gas is bad? They're not worth anything.
Nobody wants it.
So these guys own the royalties. They do not have to sell when things are bad. They only have to they can sell when things are really good. And we have a hard asset, which is the actual land, to back it up. We don't get dry holes. We own the land. So we have a bunch of assets backing up the company themselves. So there's probably more safety in this, but the safety only comes with patience and not giving up during those big swings.
And really, when you're an investor, you said this is something you really don't pay attention to. And I think specifically the stock price, that's really what you don't pay attention to. And that's pretty much Buffett's whole agenda, is ignore the stock price unless it's an opportunity to buy.
Yes.
And okay.
Yeah,
That makes sense.
me and Sam were looking at our AI infrastructure deal, and we were talking about that today. I was like, no, let's take advantage of it when it drops, and when it drops big, because this should be volatile. And as an investor, you have to have it in your core when something drops to get excited, get really, really excited. Unless you're invested in Blockbuster, but hopefully your company's good enough, that when things, if we woke up one morning and something was down 20%, I would say, everybody start raising cash. This is what we're doing. This is exciting. We're getting a BOGO, or this is too cheap to let go.
And really, when you say cheap, it's going to take less time for those earnings to pay us back for our investment in the company.
Yes.
Yeah. It's always good for me to kind of think about it and how long is it going to take me as a business owner to get those earnings back in my pocket, or at least in a way that they could be converted into a dividend or something.
Amen.
To pay me back.
Just because they're not paying a dividend does not mean you're not benefiting.
Yeah.
Every share that they buy back is the same as a dividend. You just don't pay taxes. All of that stuff matters. And, when we got big price swings, it gets scary and we forget, but these companies, that if you're owning the right ones, they are constantly returning things to the investor. You just don't get to hold it and smell it and touch it every time. That's why you got to step back. And
which is good, because you'll probably spend it just like I do.
Well, that's human nature, right? If we have it, we spend it.
Yeah.
But something interesting about this versus some other types of companies is that this has a pretty wide barrier to entry, because no two people can own, virtually speaking, the same piece of land, right?
Right.
And so as they expand their portfolio, that gives them that kind of that moat to resilience.
Amen. And if they can take that cash and turn around and buy more, this can be a perpetual trust that never slows down, and we don't have to ever worry about the lives of the well or anything like that. But that's where we need to be able to pay the most attention to, is what they are doing with their cash.
Yeah, that's pretty interesting. So when we were kind of getting started, you talked about another industry, touched on the fact that we thought it might have some barriers to entry that are kind of diminishing. I think Botox came up, where you talked about it's everywhere. Right?
One of the companies that is in our current portfolio is the company that produces Botox. They've also had a blockbuster drug, Humira, that is coming off a patent. So I'm a little bit worried about them, especially. I thought one of the biggest moats that they have, that's AbbVie, was their Botox portfolio. That was one of the most protected and what's the word I'm looking for? Most secure.
Yeah, and resilient
factories on the planet. If you're dealing with a company that is creating botulism, which could wipe out huge swaths of the population, this facility needs to be airtight. And that's not the case anymore. I went over to Sam's house the other day, and he was creating a little batch of botulism in his garage. So I think that mode is dwindling down pretty quick. And I'm not saying that they're still a fantastic company, but remember my lifespan, and I don't want to be a trader. I want to hold companies forever.
Right.
And this is one that we're kicking the tires on and saying, hey, do you belong with us or not? So that's one of the first that we're looking to get out of, and these are some of the companies that we're looking at.
And, we were talking the other day, and you were saying, how long can their return on invested capital maintain what we require? And you were talking about why they're in our portfolios, because of that moat of that drug and the patent that's on it. So the question is more so, why can they demand that return on invested capital instead of how long can we anticipate that return on invested capital to maintain?
And it's dwindling fast. Still a great company. What were you telling me? There's not a single cell out there on Seeking Alpha no bears.
Yeah,
You
yeah.
know, so that's fantastic. I'm not having to sell into weakness, but it's just I'm not as comfortable with it as I was.
Yeah, it's just a lot of optimism in the face of that decreasing moat. It's pretty interesting to go look at.
Yes.
Sorry, I was thinking about a bad Botox joke with optimism and smiling, and so anyways, that's where my mind went. But
With that
well,
big bump on his forehead.
anyways, gentlemen, this has been very insightful, and I appreciate you going through it in so much detail. I think it's exciting to understand kind of where we're at, what we're seeing, but also thinking so far in the future. I think that's important to our investors and important to kind of the future of investing, right? To stick to the disciplines and the fundamentals and kind of stay away from what they call the meme stocks, right? Kind of following the trend, because I think if you do that too much, that'll just end you up in devastation. So
Yes, it will.
staying disciplined, sticking to the facts, and the fundamentals, of course. So before we wrap up today, is there anything else you guys want to touch on?
Let's bring in Brent
Yeah,
so he can
no.
give his report, and then we'll be done.
We have a banker in here who hasn't said anything, and I'm interested to hear what his opinions are on the crypto market coming from the highly regulated financial banking system. So he has some skepticism, I think.
I don't know if it's as much as opinions as questions. Just from the outside in, as far as we know the popularity of Bitcoin or digital currency in a sense, and how technology is just evolving rapidly, and it continues to do so. And talk about banking, talk about the federal government, their involvement, and just everything, how they want to have their hand in everything. So as far as just your general consumer, their money being all digital, what gives them that comfort knowing that it is secure? And I guess just in general, what keeps the federal government from trying to dip their hand in and control what's potentially going to be the primary currency of the U.S. or globally? So any government in that matter.
Yes. And you know what? That's probably the number one selling point of Bitcoin. And again, there's big difference between Bitcoin and cryptocurrency. I know they all get lobbed in together, but Bitcoin is its own special case. Even the SEC has come out and said, "Hey, this is different than all the other ones." But back to your question, this is a completely decentralized entity. All of this is completely transparent by not just one or two people, but anybody on the planet can go look and see what's going on. And no one entity or person can take over that Bitcoin. So even if the government wanted to get their hands on it, they could not. It is a very, very safe asset from that standpoint. They can't come, and this is going to be a bad example, but if you don't pay your child support, they can't come in and confiscate that. They can't even get their hands on it unless you give them your keys to it. There's nothing like a bank where there's an open window into your account. It is truly, truly yours. And then that is really one of the strengths of it, how secure and how decentralized it is.
Now, what happened a couple of years ago? The Bitcoin price crashed. Someone went to jail. I think it was Sam Bankman-Fried. Can you kind of dig into the difference between having your own keys versus somebody else having custody and what that looks like?
So Fried, this was not a Bitcoin case. This was his own cryptocurrency that he created, and he did use it in a malicious way, and he went to jail for it. He controlled that. He controlled the narrative. He controlled everything, and he used it against the people that invested in him. What was the second part of that?
I don't know. I think that pretty much.
Well, I think Brent's talking about the faith in the system and how do we build that confidence, because
Yeah,
I think
okay.
that was a great point about we hear on the news and we don't fully understand why Fried went to jail, right? We hear crypto, we think all crypto, digital currency, understanding Bitcoin's different.
And he paid his girlfriend a bunch of the coins.
Yes.
Right, and we get spooked by that, right? The general American public doesn't understand it well enough because it's really a complex topic when we start talking about the breakdown and the system behind it.
Yes, and there's tons. We went through this point for a while that companies would go in there and create these different coins or whatever and take them to market and sell them. And they would sell them when everybody was excited, and the people created them for, a tenth of or a thousandth of a penny, and then go and sell them for $1. And then they sell, and then everybody's left hanging the bag. And there's a special word for that. I can't say it on the air, but it's not good. And that's probably where the SEC should step in for these kind of predatory practices. But that's not Bitcoin. And even I wouldn't even say there's a lot of crypto projects out there that are good, and they have a really good case for using them. So if you do stumble into that world, you really have to have an idea of what they're trying to do and whether they can accomplish what their goals are. And a lot of them are just transferring information, protecting information, because that's not easy to do in today's time.
And we talk about it a lot, about the exciting thing about that transferring information, where you're on one side of the country and you can instantly transfer in a secure manner your medical records or your financial records or whatever piece of information that may be. That's actually really exciting because I think although people are concerned about digital currency because they don't fully understand it, the idea of fraud, cybersecurity, people get that a lot. And this is this technology, right? Bitcoin itself doesn't solve that problem, but the technology behind it. So you might have more faith in that, how secure it can be.
Yeah, banks are already using it.
I mean,
instant settlement.
Yeah.
What do you think that is? That is the blockchain.
Yeah.
Banks are using it today. Chicago Board of Exchange is using it today. This technology is sound. So a lot of the negativity is being created out of fear.
Brent, what are some of the things that you faced with that? Did you get any questions about crypto? I know it's been fairly recent that it's been all across the news, but did you ever face anything like that with digital? Or because even looking at your bank app, your check deposits digitally, you might slide money between checking and savings digitally. You don't ever actually see those dollar bills. Did you get any questions or concerns about that?
I mean, as far as digital currency, not so much, but I think back to how technology is always evolved, essentially since it really came heavily. You think back to when everything was cash. You got the general banking system, everything's cash. And then you think when we're able to start writing checks.
Mm-hmm.
And then when debit cards came out. And I mean, I remember, I'm just old enough to remember kind of the fear of this debit card, how is this my money?
Yeah.
So it's just, I think it's a general fear of evolving as a society. Anything with technology, there's always going to be that fear.
Try to go to a Texas Rangers game and use cash. I went to a concert there, and they would not accept cash. It was digital only, card only.
There's so many places like that.
Took my kids to SeaWorld. Cash, or you had to convert your cash into their own type of little currency to spend within the park.
Reverse ATM stuff, yeah. It's crazy. Crazy. So I guess the biggest point is you're going to be there anyway. You're already doing it, and you're arguing against the reality of what's going on in today's world.
Well, and one thing real quick. So we talked about the Freed situation where he had his own proprietary, and then you talked about where people would start these fad coins and then dump them. But when you think too about penny stocks, they did something similar with that. They'd get a bunch of hype. The stock would go up from 12 cents to $2.50. All of a sudden, people think they got monumental returns. I remember I was getting my hair cut in Las Vegas, New Mexico, which it's smaller than Eastland. If you thought there could be something that small, and he said, "Yeah, I bought some penny stocks one time, and they were great." bought them for like 30 cents, and they went up to 40 cents. And he said, then I tried to sell them. And what I realized was I was the only volume on that stock. Yeah. So there was no market for it at all. He had it great, but it didn't mean anything. Yeah. So, there's plenty out there that's, so that should give us some confidence that not all things, even though they look the same, are equal. Not all digital currencies, although they may seem the same, are equal. There's a lot of regulation coming down. There's a lot of use, a lot of good case use for it.
Yeah, and if anybody wants to, I know I'm going to get a bunch of text or emails with questions that I can't answer, but there is a white paper that introduced Bitcoin, and you can find that at bitcoin.org/bitcoin.pdf. And that's just the original white paper where you can go and kind of get a little bit of an idea on some of the theory behind it. There's calculations on there. Don't text me. I don't know what they mean. But it'll give you some of an idea on how the security works and how the blockchain works. And it might be a good idea because who knows, in 10, 15 years we might be trading stocks through blockchain or something.
Yeah, well, and like Aaron was saying already, Chicago Exchange already uses it in some regard. So, instant settlement.
Yes, technology is sound.
I guess maybe a final question without digging too much into the bureaucracy of it and the federal government. Is there anything combative in a sense of the federal government trying to create their own digital currency to control the monetary system of the U.S. at least?
Yes, they're going to have. They're going to have one. They've been openly talking about it. It's coming. Will it be competitive? It'll be competitive in the point of how we use it. More technology will have to come out on how to make those transactions more. What was the word again?
Lubricated. I should not have used that word last week because all I've heard about was lubricating transactions and making sure that the financial system is very well lubricated. So
anyways, that's coming out. But on top of that, even the federal government coming out with their digital currency, it's not going to change the situation we're in. The only thing it's going to change is the amount of money that they can push at any given time. It's just going to be able to speed up changes in monetary policy, and be able to speed up on knowing what you're spending on and whether they allow you to spend it on that stuff.
And I think a lot of the fear comes from, naturally, you think of through the history, you can go the last 100 years, the fear of the people is essentially the government, the lack of control. I think of just, I've experienced at the bank, you got an old man coming in, he's had this money he's finding in his backyard, he's digging up that he's buried 60 years ago. The fear of, am I going to be able to control my money? Right, so. Yeah,
absolutely. And I can't remember, there was a politician or somebody out there that was using that as a reason to use it, and they were bragging, just think that you don't even have to do your taxes anymore. We'll automatically pay your taxes. We'll automatically do this. And that's what we're all scared of.
Yeah. Well, that's good, gentlemen. We better get wrapped up for today on our episode of Black and White Market Chatter on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.